Hello, friends. This is Rajadhar, and I am welcoming you all to the Friday podcast. Today is 1st of September 2023, and the GDP numbers had come yesterday. Yes, around 31st of August. And why it is important for you to know the GDP numbers, because at the end of the day, your investments, your portfolios, your money is divided into sectors, and the GDP tells you right that which sectors in India are doing good, why they are doing good, and what government is looking at projected growth rate in each and every sector. So all of you who have been investing into stocks or equity mutual funds or banking on the India growth story need to know about the GDP numbers. और आज मैं आपको will be showing how the GDP numbers are impacting your investments, or it is just a sham, or the growth rate of around 7.8%, is it really worth it, and how it impacts on your portfolio. So first thing first, what is the bird's eye view of the GDP numbers? Now we know that the GDP means gross domestic product. So if we look at from the perspective of India, for that matter, we can consider India as a big family, and the GDP is its annual income. GDP growth rate is the rate at which that income increases. And since the numbers had come up and they're quoting the first quarter GDP numbers at being 7.8%, that means India's income has increased by 7.8%. Nonetheless, it is one of the best performing numbers in the global economy, and every Indian is gung ho about it. But the matter of fact is, does this mean Indian economy and Indians are swimming in the pool of cash? So in this video, I will be actually unwrapping some of the facts so that it will bring in the clear perspective for all of you, for all the investors, to make right perspective on their investments while investing. So first and foremost, is it a real growth or a mirage? So it is a question of perspective. When they say that their GDP growth rate is 7.8%, it is vis-a-vis last year. But if we see COVID 2020, and if we see the compounded annual growth rate, which is from say 2019 to 2023, the annual growth rate is just 3.2%. So therefore, it is not that too big a number. And if we, what we say that if we give ourselves pat on the back, we are still good among all the other economies on the world. So it is likely to be said that there is a lame person who is running into a race where the people have it amputated in both their legs. So having said that, yes, we are good, we are better than others, but the numbers are not that good because there are many sectors which have not still got back. So if we talk about the performers, who are the star performers? Who is the Shah Rukh Khan of the GDP contribution big made? Who is the most GDP contributor of all? So that is services, services, and services. Financial services, real estate services, and professional services. So it has been led by infrastructure growth story because that has been fueled by capital expenditure. There have been the banks, the credit that has gone into the market, and the bottom line of the banks have increased. So all that has led to the higher contribution into the GDP numbers. So we can say that that has gone well for that, but it is still top heavy. So it is just like having an Indian cricket team where only Dhoni and Kohli are playing and the rest 8 players are doesn't have made any contribution. So it would have been rather than 7.8, it would have been 8.2. So while we're talking about the top performers, then which are the sectors which are not performing? So if there is trade, there is tourism, there is travel, transport, hotels, they have not performed well. They have been still a laggard and they have not caught back after the COVID the way they should have been. So that is one aspect of it. And when we talk about the older pillars of the GDP, the traditional pillars, so there is manufacturing and there is agriculture. We say that agriculture is still struggling with 3.5% contribution. So agriculture has 3.5. Services, which have been ruling the roost, has been growing at 12.2%. Agriculture is 3.5%. And with 4.2, we are having the manufacturing. Or 4.7, we are having the manufacturing. But still, we are having the manufacturing. We shouldn't be too happy the manufacturing has increased vis-a-vis last year. It is just like patting the back and being happy that a child who used to get C grade, C grade, C grade in each and every test has now got B minus. So having said that, manufacturing, the PLI schemes launched by the government of India would take many more quarters to actually get translated into the bottom line of the manufacturing. But that is actually a pain point, because unless and until the manufacturing and the agricultural that bedrock doesn't become stable and growing, it the much of the economy can't grow. How much of the service sector will grow? It should need a support from the allied sectors for that matter. So while we have discussed about sectors which are the performers, the laggards, and the old timers, where the private consumption is going. So many a times we see that people, when invest in stocks, they say, okay, there is a volatility into the market, and let's invest in stocks which are having the private consumption, because people will keep on consuming. Now, it has, in the report, it has come that Indian consumption has grown by around 6%. That is really a good number, because Indians are under an impression that they have saved a lot and now they should go for some discretionary spending. But this blip in the private consumption or the spending is momentarily. It is a discrepancy, and it will normalize over a period in time, and that will show into the private consumption stocks or the sectors, and that might see a correction. So therefore, if people are having an exposure to private consumption sectors or the stocks, they need to take a conscious call while acting on it. So therefore, in that case, in the whole economy, and when the GDP is concerned, where the money is actually getting pooled into, where the fund is flowing. Because if you're investing in mutual funds or stocks, you should be betting on the horses which are the ones who are leading the race. So therefore, the prudent thing will be, we have to see where the government is spending, and based on that, we should actually uh, go and make our spending or make our investments. To substantiate this fact, you'll be surprised to know that around 34.7% has been the contribution of capital expenditure by the government of India into the GDP growth rate. So that simply means government is actually, from whatever the income it is generating, around one third it is spending into creating the assets or the infrastructure, or those assets which can keep on generating the future income. Capital expenditure statistics show that for every 1 rupee that the government spends into capital expenditure translates into 4.7 rupees of the output. So nearly it quadruples the money whatever the government is contemplating, or what the government is actually contributing into the capital expenditure. But the irony of the fact is, while the government has played its role very well, the corporate structure has not gone all in. They are still sitting on the beach and testing the waters, because they are not understanding the fact, unless and until you don't jump into the sea, neither you can get pearls nor you will get minerals. You can just get your feet wet if you're on the beach and not testing the waters. So therefore, the coppers still need to get all in, because if they go all in, we will see bull run in many of the sectors for at least next 4 5 years. Infrastructure is a big short game that will actually is already into an upcycle, like 2007 when it had gone up, because this is how the structural growth of the India has been there. So while we have covered the sectors, we have covered the private consumption where the people are spending money, we have covered where the government or corporates have spent money, there is also an aspect how the exports are faring. That is much of the mixed bag, because many of the global economies have been hit hard. India has also been hit hard, but still among that, the India has performed fairly well. But there is still much scope of India doing well in that case. Then, looking at all these perspective, if we have to think that, okay, what is there for India the way ahead? So they have predicted that we are looking at 8% or 8.1% of the growth, GDP growth. Unless and until we don't see any impact due to headline inflation or the food inflation or global trepidations that happen, this is more or less achievable. And it will be much easier achievable if the corporate sector makes the private investments into the sectors, and that will actually give the bull run in the economy and do that. So making a closer remarks, if we see the sectors, we can still see over the next quarter financial services, real estate, infrastructure still doing good. But this all should be in sync with your asset allocation, with your life goals, with your cash flow requirements. And if you're needing money in next 6 months, there is no point investing money in the stocks or the mutual funds, because that won't serve any purpose. You are unnecessarily exposing yourself to the risk. So main factor is you need to consult your financial advisor, broker, agent, and then decide where and how your portfolio needs to be allocated and rebalanced. But having said that, it is a no-brainer that India growth story is still intact, but there are stocks, there are segments which are highly valued. Mid caps and small caps have gone up the roof. You need to get into stocks, into sectors which are still undervalued, still low, so that you are having a good bargain. As you can see, in the recent past, mutual funds have again started accumulating IT stocks which had gone down and invest into. You can invest into a growing company which is less valued rather than into company which is 3 times its valuations or the 4 times its valuations, because it will make the growth more harder for the new money to make money for you. So thank you so much. This is Raja Dhar signing off. Have a great investing. Thank you so much and see you next week. Thank you so much.